we've had a pretty big couple of days on the economic data front, and for once it's actually given us a bit of good news. Because this morning we've had the inflation numbers drop, and CPI has now fallen from 3.4% down to 3%, and that's a decent move. Now, we're not at the Bank of England's 2% target yet, so let's not get too carried away, but the direction is exactly what we want to see. And the thing is, inflation coming down like that matters because it gives the Bank of England room to breathe. It means they don't have to keep rates high just to prove a point. Now, what makes this even more interesting is when you link it back to what we had yesterday with the jobs data, because yesterday's figures weren't great, let's be honest. Unemployment has risen to 5.2%, we've had payrolled employee numbers falling, and overall it was basically another sign that the labour market is starting to soften. And that's important because when unemployment rises, it usually means the economy is slowing down behind the scenes. So when you put the two together, inflation falling and the jobs market weakening, that is exactly the type of combination that starts to change the conversation around interest rates. Because at that point, the Bank of England is thinking, right, inflation is coming down, but the economy is starting to wobble. So how long can we realistically keep rates this high? And this is why people like me pay attention to these numbers. Because it's not just about what base rate is today, it's about where base rate is likely to go next. Now, does this guarantee a rate cut at the next Bank of England meeting? No, it doesn't. But I'll be honest, it definitely increases the likelihood, and in a very big way. Because if inflation is falling faster than expected and unemployment is rising at the same time, the bank has a much stronger justification to start easing rates. And if tomorrow's headlines are all about inflation cooling and growth slowing, it becomes harder for them to justify holding rates at these levels for too long. Now, what does this mean for mortgage rates? Well, this is the key bit. As you know, mortgage lenders don't just price fixed rates based upon today's base rate. They price them based upon expectations of where the market is moving. So if markets start believing that rate cuts are coming sooner, swap rates tend to soften, and if swap rates soften, fixed mortgage rates can drift down. And that's why you'll often see mortgage rates move before the Bank of England even touches the base rate. So in simple terms, today's inflation drop is a positive sign for borrowers, and we could see lender pricing improve sooner than we think. It's the kind of data that supports mortgage rates continuing to gradually improve over the next few months. Now, from a housing market perspective, this is also a bit of a boost, because what the housing market really needs right now isn't hype, it needs confidence. It needs buyers to feel like the worst is behind us, and falling inflation is part of that. Because it supports lower interest rates, it supports better affordability, and it helps people feel like they can actually plan again. So yes, this is good stimulus for the housing market. But, and you know me, there's always a but, we do need more than just one good inflation print. Affordability is still tight, people are still stretched, and confidence is still fragile. And that's why I still think that the government could do something really simple that would help the housing market massively. And that's stamp duty reform for downsizers. Because at the moment you've got a lot of older homeowners sitting in big family houses. They'd happily downsize, but they don't want to pay a huge stamp duty bill just to move into something smaller, so they stay put. And the knock-on effect is that family homes don't come back onto the market, chains don't get moving, and everything slows down. If the government introduced a stamp duty freeze or some kind of relief for downsizers, you'd unlock movement at the top of the market, and that filters all the way through to the bottom. More transactions, more supply, more activity, more confidence. So overall, inflation dropping from 3.4% to 3% is genuinely good news. When you combine that with yesterday's weaker jobs data, it definitely increases the chances that the Bank of England will start looking at cuts sooner rather than later. And if that happens, mortgage rates should continue to edge down. Now, I'll cover all of this properly in Friday's full weekly update, but for today, this is definitely one of those data releases that matters, because it's a step in the right direction.